Because of my accounting background, I obviously pay a lot of attention to financial statements. And I would identify companies based on screens, or I might read about the video gaming system, video gaming industry, and I would study Activision and Electronic Arts. I like to do 2 or 3 companies in each industry. And I would go back, we don't own it yet. It's a fascinating industry, and the stocks are very expensive, but I follow it. One day we might own it, but I go back 10 years. So I go through the 10Ks and I go back 10 years and I spread the numbers myself. And I get a real good feel of the growth of revenues and earnings and profit margins and capital allocation. And I take a very dim view of stock-based compensation. And I've done many studies, and every company I do that sort of analysis, where I take the stock issued to employees, and I take the average price for the year, and I take the stock issued, and I multiply it by the average price, and I say, you've diluted the shareholders, and this is what it would cost to buy back that stock, to bring everything back to even again. Which, it's just nonsense for management to say that stock-based compensation is a non-cash expense. When you buy back that stock, you spend a lot of cash. And then I net off the employee contributions when they exercise and the tax benefit. And then I say, okay, if they, what percentage is that of revenue? And then I say, if they had paid employees that in cash, 3% of revenue or 15% of revenue, and then they'd use their free cash to buy back stock as they did, then they would really shrink the share count. I remember doing it for Microsoft in 1999, and I had an intern who worked at David Tyson. He went and worked for Microsoft, and it's a long time ago, but basically I said if they'd never issued stock and they just paid a 15% bonus, I think the average salary would have been something like $288,000 per employee, whereas the average came to about $450,000. But $228 is pretty good. Eh? And then if they had used their free cash to buy back stock, they would have earned, say, $3 a share instead of 80 cents, something like that. And then you look at a stock like Fastenal, which had no stock options. The CEO owned 30%, and the CEO took his own stock holding and issued options out of that to the executives. So he diluted himself, not the shareholders. And Fastenal had a PE around average about 30. So if you'd applied Fastenal's PE to Microsoft, it became a much more valuable company. And I sent it to this guy, and I'm sure he showed it to the CFO. And Gates told CNN, I don't know if it was 2000 or 2001, the biggest mistake I made in business was to give my employees stock. Because they stopped after that. After that they stopped, no more stock options. I think they still have restricted stocks. But restricted stocks, that's fine, because it's expensed at the market value at the date it's given. And it's always in much lower quantities than stock options. So I calculate what it would cost to what I call mop up the dilution. And I look at the free cash and I adjust the free cash for that to get what I called unfettered free cash. I actually wrote an editorial for Barron's on that in 2004. And I used to go after Cisco in a big way, because Cisco, over about a 10 or 12 year period, bought back 2 billion shares at $50 billion, which was their total profits, and about 30 billion net of employee contributions. And Cisco, some companies keep that in treasury, and other companies cancel the stock. And if you do that, part of it goes against your retained earnings. And if you do it in a big way like Cisco, you actually find that you then have a deficit. So Cisco in 2008 had a retained deficit and it was a true reflection, because they basically took all their profit they made and just bought back stock, which they'd given to employees. because the share count was like 6,000 billion in 1998, and it was 6 billion in 2007. So they bought back 2 billion, but the share count stayed the same because they just basically gave a coupon at the front door and bought it back at the back door and said, oh, well, that's not an expense. So whenever somebody wrote, whether it's Financial Times or Barron's, oh, Cisco's giving money back through stock buybacks, I would write a letter and say, please clarify that. They're not giving it to the shareholders, they're giving it to the employees because they're just buying back the employee stock. Cisco shareholders is on a treadmill to nowhere. And I think today Cisco doesn't issue stock anymore either. So I think I like to think I had some little input there in fighting this stock option thing. So that it's sort of unconventional analysis. It's conventional analysis, but then I apply an unconventional approach to it because I want to know that there's a very close relationship between free cash after adjusting and then I reconcile free cash with earnings and things like stock-based compensation versus what it would cost to mop up the dilution. Stock-based compensation is always about half of what it would cost to buy back. So I try and reconcile the earnings with free cash flow. So if they track each other very closely, I get far more confidence in the numbers.